Investing in 2024 is worth doing as well as challenging too. Do you ever feel overwhelmed by too many investing options and not enough expertise to choose the best ones? One of Buffett's most famous quotes is, "Be fearful when others are greedy and greedy when others are fearful." Warren Buffett is one of the top long-term investors. So many people listen to his advice and apply it to their lives. So here are Warren Buffett's investment tips you must know in 2024. Let's get into it. Investing is a long-term game. It takes time for money to accumulate, and you can't have a baby in 1 month just by getting 9 different women pregnant. Warren Buffett is simply stating that some things take time, regardless of how talented the people involved are or how hard they try. When preparing investments, one should do it with an eye on their long-term objectives. The investor goes into futures and options trading with the expectation of making rapid money, but in reality, the investor is the one who suffers the greatest financial loss. Warren Buffett was never involved in the trading industry. There is another quote attributed to Warren Buffett that goes as follows: "If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. Diversification isn't always a good idea. When it comes to making investments in the stock market, diversification is recommended as a sound strategy by a large number of successful investors. On the other hand, Warren Buffett is often not a fan of the concept. According to Warren Buffett, those with a limited understanding of the financial market should use diversity. An experienced investor should choose stocks with a long-term outlook and have faith in the returns of their investments. Diversification is a protection against ignorance. It makes very little sense for those who know what they're doing." Warren Buffett. Some investors choose to diversify their holdings because they are concerned that the loss of just one company could wipe out their entire portfolio. However, doing so makes it significantly more difficult to maintain a singular concentration on each particular investment. They may see less volatility in their portfolio as a result of diversification, but at the same time, they will have less concentration on specific investments. An excessively diversified portfolio is one that contains holdings from a large number of different companies, which reduces the impact of the portfolio's higher quality investments. The idea of excessive diversification is madness. Charlie Munger. Don't invest in a company whose business you don't understand. This is one of the most essential pieces of advice that Warren Buffett has for investors. People will put their hard-earned money into an investment just because they have heard positive things about a particular company from other people. If you are familiar with the company, you will be able to predict whether or not there will be any linked economic troubles in the future. There are numerous companies trading on the stock market whose operations are simple enough for the average person to understand. Buffett cautions that you should never invest in businesses whose operations you do not fully understand. Trust yourself to be a successful investor. According to Warren Buffett, the most difficult thing is having faith in the choices you make with your investments. You always believe that other people are correct and that you are in the wrong. Instead, you should focus on your studies and have faith in yourself. "I always knew I was going to be reached. I don't think I doubted for a minute." Warren Buffett. You have to get over your fear and tune out what other people are saying to you if you want to have any chance of becoming successful. Acquire knowledge and devise strategies for investments in order to set yourself apart from the competition and emerge victorious. Never compromise on business quality. It's pretty easy to say no to companies and industries that are too complicated, but it's harder to find good businesses. In the last 50 years, Warren Buffett's business philosophy has changed. Now he only buys high-quality companies that look like they will continue to grow in the long term. Investors may be surprised to learn that Berkshire Hathaway was Buffett's worst bet. Buffett wanted to buy Berkshire, a textile company, since it was cheap. He believed that if you bought a stock at a cheap price, you would generally receive positive news that would allow you to sell it for a profit, even if the company did poorly. He considered cigar butt trading after more experience. He remarked that buying firms in that way is stupid unless you are selling. The bargain price may not be so great. In a difficult industry, one problem often becomes another. These enterprises also offer modest returns, making the initial investment even less valuable. Because of these findings, Buffett came up with this famous quote, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." Warren Buffett. Our key financial ratio for business quality is the return on invested capital. Companies with strong capital returns can compound earnings quicker than those with low returns. Thus, these companies gain value over time. Time is the friend of the wonderful business, the enemy of the mediocre. Warren Buffett. Most news is noise, not news. Daily financial news arrives in our inboxes. We read several headlines but ignored most of the content. The 80-20 rule states that 20% of causes cause 80% of outcomes. We believe the 99-1 rule applies to financial news. 99% of our investment decisions are based on 1% of the news we consume. Most TV news headlines and dialogues are meant to create excitement and motivate us to act. Owners of stocks, however, too often let the capricious and often irrational behavior of their fellow owners cause them to behave irrationally as well. Because there is so much chatter about markets, the economy, interest rates, the price behavior of stocks, etc., some investors believe it is important to listen to pundits and, worse yet, important to consider acting upon their comments. Warren Buffett. We invest in firms that have survived. Many have been in business for over 100 years and have weathered practically every unexpected hurdle. Imagine how much negative news came from their companies. However, these enterprises remain. Does it matter that Coca-Cola missed quarterly earnings projections by 4%? Since Johnson & Johnson stock has fallen 10% since my purchase, should I sell? Should I sell ExxonMobil shares when oil prices fall? These questions are usually answered no. Such issues can dramatically affect stock prices. Financial news outlets must hype these topics to engage viewers. Remember that the stock market is a manic depressive. Warren Buffett. Investing isn't rocket science, but there is no easy button. People think that only very smart people can pick good stocks, which is one of the biggest misconceptions about investment. Still, intelligence alone isn't a very good indicator of how well a project will do. You don't need to be a rocket scientist. Investing is not a game where the guy with 160 IQ beats the guy with 130 IQ, Warren Buffett. Though Warren Buffett's investment philosophy is easy to follow, it is incredibly hard for anyone to regularly beat the market and avoid making bad decisions. Just as important, investors should always remember that there is no magic method, set of rules, or easy button that can beat the market. It's not real and never will be. Investors should be skeptical of history-based models. Constructed by a nerdy-sounding priesthood, these models tend to look impressive. Too often, though, investors forget to examine the assumptions behind the models. Beware of geeks bearing formulas. Warren Buffett. We think that anyone who says they have such a method just to get more business is either very naive or just another snake oil salesman. Watch out for gurus who try to sell you a hands-off, rule-based way to spend. The owner wouldn't have to sell books or memberships if there was such a system. It's easier to fool people than to convince them that they have been fooled, said Mark Twain. Investors are often asked to work harder than necessary. Warren Buffett's common sense advice can help you manage your portfolio better, minimize costly mistakes, and increase your investment return. So, that's it for today's video. Don't miss out on our future content. Hit that subscribe button now. Stay tuned and stay amazed.